Okay, so for this video series, we're diving into AUC Section 240 that discusses the consideration of fraud in a financial statement audit. And this AUC Section 240 is one of the longest sections in GAAS, and we'll go through each of the parts of it here. But first, for this video, we want to understand kind of the scope of this AUC section. So we see first that it was put together by SAS numbers 122 and 128 and is effective for audits for periods ending on or after December 15, 2012. And as far as the scope of AUC Section 240, it addresses auditors' responsibilities related to fraud in a financial statement audit, and it's supposed to be used in conjunction with AUC Section 315, understanding the entity and its environment, assessing its risk of material misstatement, and also Section 330, performing audit procedures in response to the assessed risks. And so we remember from AUC Section 200 that the auditor's responsibility isn't necessarily to find fraud, it's to find misstatements that may be due to error or fraud, and that's a very important distinction, and part of why this entire section was put together so that we understand that difference. And so going down to the section characteristics of fraud, AUC sections 240.02 through 03, it explains sort of what or in what way GAAS views fraud. So as we discussed, misstatements can arise from fraud or error, and the distinguishing factor between whether it's fraud or error is whether the underlying action that results in the misstatement was intentional or unintentional. So an intentional misstatement would be fraud, an unintentional misstatement would be error. And so we see here that fraud is a legal concept which is really outside of the bounds of our knowledge and experience. But for GAAS purposes, we're primarily concerned with frauds that cause a material misstatement of the financial statement. So we're really not obligated to make a legal determination of whether fraud has occurred. We merely need to find out if a misstatement has occurred, whether that's due to fraud or an error. So for our purposes, there are two types of fraud that may cause misstatements, and that's a misstatement resulting from fraudulent financial reporting and misstatements resulting from misappropriation of assets. And so that's discussed more in detail here in the explanatory material in sections A1 through A8. So let's go down to those sections and get some more color on what exactly constitutes fraud and how we should view it. Okay, so we're down in the explanatory material. Here we're discussing the characteristics of fraud, starting here with A1. And the first little part here describes what we call the fraud triangle. Triangle has 3 points, and so typically in order for a fraud to occur, there usually have to be three items present, and that's an incentive or pressure to commit the fraud, perceived opportunity to do so, and some rationalization of the act. And that's what's usually referred to as the fraud triangle. And we have some examples down here of what might be perceived for each of these corners of the triangle. And because we have two types of fraud, for instance, fraudulent financial reporting or misappropriation of assets, then these examples have both of these, I think. So the first is the incentive to commit fraudulent financial reporting. And for the incentive, that might be pressure from sources inside or outside the entity to achieve an expected outcome. And that might be maybe an earnings target or a financial outcome. And for instance, maybe if the shareholders of the company expect the company to achieve particular earnings, then the fraudulent person might misstate the financial statements to make it appear that the earnings target was achieved. And that might be linked to maybe their bonus. It depends on if they met that earnings target. So that would be a big incentive for someone to do so. And similarly, for the misappropriation of assets type of fraud, maybe an employee is living outside of their means, so they need to somehow steal money from the company to support their expensive lifestyle. So that would be an incentive to misappropriate those assets. So next we have an opportunity to commit fraud. An example of that might be that internal controls are not designed or implemented correctly, or that they can be overridden by a member of management to commit some kind of fraud. And that's why we see throughout this AUC sections that to watch for controls that can be overridden, because it's very important. That can be a very good opportunity for fraud to occur within a company. And finally, we have rationalization. And so this is where an individual has an attitude, character, or a set of ethical values that allow them to knowingly and intentionally commit a dishonest act. So perhaps an employee sees that the owner of the company or the shareholders have been making a lot of money, and maybe they rationalize that, hey, that owner would be okay if I stole some of this money. So there's maybe a lot of rationalizations that occur. So in summary, these three items make up the fraud triangle, and usually they're all present when a fraud has occurred. Going down to the next part here, it discusses the fraudulent financial reporting. And we see here that it involves intentional misstatements, including omissions of amounts or disclosures in financial statements to deceive financial statement users. And it might be used to manage earnings or to deceive financial statement users. And sometimes it might start out with small little frauds, but it may slowly increase to an extent that results in fraudulent financial reporting. And it doesn't necessarily have to be a means to increase the earnings of the company. It could be a means to decrease the earnings of the company to minimize tax to be paid for the earnings. So we need to be aware of several situations that fraudulent financial reporting might be incentivized. And so as we saw in AUC Section 200, our responsibility as of an auditor is to obtain reasonable assurance about whether the financial statements as a whole are free from material misstatement, whether caused by fraud or error. So it's not our responsibility to find every fraud or every misstatement that occurs because of fraud, but only those material misstatements that could be caused by fraud or error. And as a result, we're only concerned with fraud that causes a material misstatement of the financial statements. However, in some circumstances, we might find immaterial misstatements due to fraud, and in future videos, we'll discuss those in sections 35 through 42 here. So as we stated above in the requirement, the determination of whether it's a fraud or it's an error is on whether the misstatement was intentional or unintentional. And so determining that intent is usually pretty difficult to determine. Maybe someone did it by accident, or maybe it was by purpose, and usually we may not be for certain which one of those it is. However, that's a moot point because our audit is not designed to determine intent. Our objective is to obtain reasonable assurance about whether the financial statements are free from material misstatement, whether due to fraud. So our intent in an audit, or our objective in an audit, is not to determine whether something is fraud or whether it is an error. Our objective of the audit is to determine whether there is a misstatement, which could be due to error or fraud, and we're not sure. So going down a little farther, we have some examples of how someone might perpetrate fraudulent financial reporting, and that might be done by manipulating or altering accounting records or supporting documentation for which the financial statements are prepared. It could be by misrepresenting or omitting financial statement footnotes or disclosures related to events or transactions that would be very useful for financial statement users to know about. And it could also be accomplished by intentional misapplication of accounting principles relating to the amounts, classifications, and manner of presentation or disclosure. And typically these items would come about because of management override of controls. And those examples of those controls overridden might be recording fictitious journal entries, inappropriately adjusting assumptions, and when you're estimating certain account balances that require significant judgments. Also, maybe omitting or advancing recognition of certain financial statement events and transactions that have occurred, concealing or not disclosing facts that could be important to financial statement users, engaging in complex transactions that make it difficult to understand what's happening and may misrepresent the financial position or performance of the entity, and also altering records related to significant and unusual transactions. So we see here there's a lot of ways for financial statements to be fraudulently reported, and a lot of ways that this could occur through the management overriding of controls. So now let's take a look at the misappropriation of assets. How might assets be misappropriated? First, we need to understand exactly what that is. It's the theft of an entity's assets, and it's often perpetrated by employees in small and immaterial amounts. Although it can also include management because they're better able to conceal the fraud and not be detected. And so misappropriation of assets can be accomplished in a variety of ways. The first one might be embezzling receipts. So for instance, when they receive a check from a customer, maybe they deposit it in their own personal bank accounts. They could also steal physical assets or intellectual property. For instance, stealing the company's inventory or scrap for resale, or providing intellectual property information to competitors and selling it to them. Someone misappropriating assets could also cause the company to pay for goods and services that the company didn't receive. For instance, maybe they pay fictitious vendors who are actually themselves. Maybe they pay kickbacks to vendors and to the entity's purchasing agents in return for approving purchases at really expensive prices. Or maybe they pay fictitious employees that actually go into their personal bank accounts. And finally, maybe the least significant of all these potentially is using the entity's assets for personal use. Although this one could cause a pretty big problem if using the entity's assets as collateral for a personal loan. And so these four examples provide a variety of ways where it's when the company receives money, when the company pays money, when the company has assets that could be stolen. So there's a variety of ways that fraud could be perpetuated through misappropriating assets, and that's why good, proper internal controls are important for safeguarding against these types of things. And finally, typically, these misappropriation of assets is accompanied by false or misleading records in order to conceal the fact that the assets are missing or have been placed without proper authorization. And that's why an internal control processes, we we recommend the separation of the task of who is recording the assets and who is maintaining or monitoring the assets.